When people talk about building wealth, the financial industry makes it sound like you're trying to build a spaceship in your garage. You've got all these complex dials to monitor.
Yeah, like risk parity and all that stuff.
Exactly. It's basically trying to balance out volatility so one sudden crash doesn't just wipe you out. It feels like if you turn one knob wrong, the whole thing just explodes.
Well, Wall Street actually thrives on making you believe you need an astrophysics degree or a highly paid professional to read those dials. I mean, it justifies their entire fee structure.
Right. So today we are doing a deep dive into J.L. Pollins's book, The Simple Path to Wealth. And the core argument here is that financial independence, what he colorfully calls FU money, is achievable through a brutally simple formula.
Basically, you spend less than you earn, avoid debt, and just relentlessly pour the difference into broad, low-cost index funds.
Right. So let's look at that investing mechanism first. The book claims a total market index fund beats active stock picking and, even professional advisors.
Yeah, because of what Collins calls being self-cleansing.
Wait, self-cleansing? Like it just drops the losers automatically?
Exactly, because an index fund holds a piece of the entire stock market. When poorly managed companies fail, they naturally drop out of the index. And when new innovative companies emerge and grow, they automatically take up a larger share of your portfolio. You never really have to predict the next tech giant.
You just own it by default as it rises.
Right.
But, I mean, from a purely mathematical standpoint, isn't there a mathematically better way to do this?
What do you mean?
Like, take Paul Merriman's optimized four-fund portfolio. That strategy intentionally overweights specific areas, like small-cap value stocks, which historically offer higher returns. Why settle for average market returns when you can optimize?
Well, the math behind optimization is completely valid. A multi-fund portfolio can absolutely yield higher returns on a spreadsheet. But the flaw there is human psychology.
Because of all the tinkering you have to do.
Right. Optimization requires constant tinkering. To maintain that balance, you have to continually rebalance, which means actively selling the funds that are making you money and putting that cash into the ones currently losing money. Most people simply cannot stomach doing that during a 20-year market roller coaster.
Yeah, the tinkering is where people break their own wealth. The more moving parts your strategy has, the more opportunities you have to panic.
Exactly. And this is also why the book comes down so hard on financial advisors. A typical 1% management fee sounds tiny, right? But over 30 years, it drops your long-term success rate from an impressive 96% down to around 65%.
Wait, hold on. How does a 1% fee cause a 30% drop in your odds of success? That's wild.
It's reverse compounding. You aren't just losing that 1% fee this year. You are losing the exponential growth that specific 1% would have generated over the next 3 decades. It just hollows out your portfolio from the inside.
Wow. Okay, so let's say you followed the simple path, avoided the fees, and built that wealth. The next major claim in the book is how to ensure you don't run out of money in retirement.
Yeah, relying heavily on the 4% rule.
From the Trinity study, right?
Yes. The Trinity study was a famous paper from the 90s. It ran historical market data and found that if you withdraw 4% of your portfolio in your first year of retirement and adjust for inflation every year after, a 50-50 stock-bond split survived a 30-year retirement 96% of the time.
So on a $1 million portfolio, you pull out $40,000, but here's my hang up with taking this as absolute gospel.
Historical returns.
Yeah. This math relies heavily on historical periods where the U.S. market returned an average of nearly 12%. What happens if the year you retire, the market immediately tanks by 20%?
That is the crucial vulnerability in the book's rigid math. It's called sequence of returns risk. If the market crashes right when you start taking out your 4%, you are forced to sell off a much larger chunk of your shares just to get your $40,000.
So your portfolio gets permanently depleted.
Exactly.
Yeah.
Even when the market eventually recovers, you just don't have enough shares left to ride the wave back up. So the idea that you can just hit a magic 4% number, put it on autopilot, and walk away is highly speculative.
So it's not foolproof.
The underlying logic is sound, but relying blindly on the exact math is a mistake. The real safety net isn't a fixed withdrawal rate, it's flexibility. Surviving a market crash requires the willingness to temporarily cut your spending so you don't sell off your shares at the absolute bottom.
Got it. So the core message here, simplicity, avoiding debt, dodging high fees so compounding can do its job, is a rock-solid foundation. But the foolproof guarantee of past historical returns requires you to keep your hands on the wheel a bit when it's time to actually spend the money.
For sure. And, the ultimate goal of all this wealth accumulation in the book isn't actually luxury anyway. Collins uses this great parable about two childhood friends to illustrate this.
The monk and the minister?
Yes. One is a monk who lives simply on rice and beans. The other is a minister who serves a king and lives in luxury. The minister tells the monk, if you learn to serve the king, you wouldn't have to live on rice and beans.
Oh, I love this part. And the monk replies, if you learn to live on rice and beans, you wouldn't have to serve the king. The point is that true wealth is freedom, not stuff.
Which is a really profound way to look at our daily financial choices.
It really is. So look at your current expenses. Take a walk around your house. Ask yourself, how much of what you own is actually owning you, tying you to a job you don't want, and actively delaying your financial freedom? Something to think about before you start overcomplicating your investments.